Toni Sacconaghi from Bernstein, a longtime Tesla bear, was on CNBC to discuss Tesla's growth outlook and why he's underweight on the stock. Today, we'll watch this video and get his perspective. We'll compare how the Tesla bears sees the future and how the bulls see it. But then we'll also show how Toni has never had a buy rating on Tesla since he started covering it in 2016 when the stock was at $16. We've got Jeff Lutz joining us, and he loves doing this. Take a look at CNBC experts, and then we compare how we bulls look at it versus bears. Welcome, Jeff.
Great to be with you, Bert.
Let's take a look at this video from Toni Sacconaghi from CNBC.
Guest this hour says that his best idea for the new year is an underweight position in Tesla. He sees delivery and revenue estimates for 2024 and 2025 coming down materially, he says, and it's also a warning of growth, a narrative around the company that he believes could weigh on the multiple. Join us right now is Bernstein senior research analyst Toni Sacconaghi. We're also going to ask him, of course, about Apple hitting the $3 trillion market cap level again and regulatory and China risk for that company. But let's start with Tesla. You have been negative on Tesla, but now it sounds like you're more negative.
Good morning, Andrew. Look, I think the backdrop is important here, both the market and for Tesla. So the Magnificent Seven have had an incredible year, as everyone knows. And I think there will be scrutiny on these names as we begin next year and people level set and say, where do we go from here? And we think Tesla's earnings are going to be flat next year. We think they're going to have to lower expectations around deliveries for next year. And the stock is trading at nearly 100 times our estimate for next year's earnings. And so if collectively the Magnificent Seven are going to, potentially pull back and investors are going to think about these stocks more critically, certainly Tesla is one of those companies where I do think that we could have underperformance. And as you mentioned, Tesla did very well this year. The stock almost doubled, despite the fact that earnings were essentially cut in half. Analysts thought they'd do about $6 in earnings a year ago. They're going to end up doing under $3. And the stock was remarkably resilient because people believe, that growth is still intact. And I think 24 and 25 are going to be pretty tough years for Tesla. And so you do run the risk of losing this growth narrative. And it's really hard to sustain a multiple like that if people are doubting your growth.
But let's just talk about the growth piece of it, because I understand the margin compression piece of it. But I'm curious sort of what you think about the growth piece of it and the idea, if you believe, and look, it's been a long time, you need the breakthrough to happen. If you believe the sort of self-driving car narrative, if you believe some of the tech narrative, does that change any of these dynamics?
If Tesla was able to deliver and regulators were able to accept full self-driving, a year from now, that adds potentially $10,000 plus in profit per car, and that dramatically changes the economics. We think that over time, full self-driving will become democratized, that there are lots of really big companies investing lots of money in full self-driving. And so Tesla may very well get there first and may be able to command higher prices for a few years. Like everything in the auto industry, competition drives down pricing. So that $10,000 per car, if Tesla's able to capture that 3-5 years from now, that could be $1,000 or $2,000 per car 5 years after that.
Right. Let's pivot for a moment.
Go ahead, Jeff.
First off, the facts here is, like you said earlier, he's never had a buy rating since $16. He's missed tremendous upside, 16 to 400. Now it's, 240, 250. He's missed tremendous upside for anybody that's bought his research. Analysts tend to overcorrect in both directions. A year and a half ago, 2022, 21, 22, analysts saw this, this EV adoption curve growing. They saw Tesla really getting through the pandemic and really just crushing it in terms of getting product out. Gross margins were great, and they overshot, in terms of earnings up to, over $6-7 of earnings estimates. Now you have analysts overcorrecting in the other direction, and they're being quite bearish. And what I look at as an investor, again, this isn't advice, but markets tend to look ahead. It's December 11th. And at some point, markets are going to be even looking ahead of 2024. Now, 2024 is obviously still important. This quarter's, has some level of importance to it as well in terms of Tesla getting to the 1.8. But markets tend to look ahead. Markets are looking at Tesla installing this capacity. They look at them getting closer and closer on these huge technology breakthroughs, whether it's full self-driving, whether it's what they're doing on the energy side and ramping that up as well. The Shanghai piece of that's going to be adding to that soon. Lathrop getting the full capacity. You've got all these, I call it, kind of option plays on Tesla that are ramping up in the background. And all it takes is for one of those to kind of spring forward. This thesis then is blown up, as he said in the interview. It's not going to be a binary on-off switch. It's not going to be regulators approve FSD, add $10,000 to every Tesla tomorrow. You're going to see this adoption continue to ramp up as the software improves and as it solves problems for consumers. FSD adoption ahead of robotaxi is going to be a big thing. That you can just get in your car, voice a location, and it takes you there pretty much uninterrupted every time. When the performance gets to that uptake will be rather significant. So I think there's a number of things. I think it's the overshoot, undershoot mentality. We're going into 24 now. We've got Cybertruck ramping. We've got people getting, reservations. They're already getting delivery notices. I think that's a bit of a surprise. I think there's a lot of people that said that they're going to do 10 cars at the event, nothing more for the year. We don't know exactly what they're going to do this year, but it looks like there's a lot of activity that's brewing under the surface. And like I've said with Cybertruck ramp, it's going to be slow. It's going to be methodical. But as they get through they break through these issues that have been slowing them down. Once they break through an issue, all of a sudden, the level of production will shoot up rather significantly. I think it's the overshoot, undershoot mentality, and it's these option plays with Tesla that he continues to miss, that the market values. And this other mentality too of with FSD, like others are working on it and therefore others are going to get there. And I believe at some point over some period of time, that may be true. Although I think others are going to get there through a license with Tesla. I think it's going to take a significant period of time. I don't think these analysts understand how to measure intermediate progress on some of these big technological breakthroughs. They just think Baidu's doing it, this person's doing it, but then all of a sudden Cruise is doing it. But when you lift the covers and look under, oh, wait a minute, they're losing, $3 billion a year, quote unquote, doing it. Oh, they've got people behind a curtain navigating cars, the 1.5 people for every quote unquote full self-driving car behind it. The level of detail I think is missing. And the final thing I'll leave you with is they give the Tesla supply chain a 0. And I think that's completely wrong. The Tesla supply chain in Gartner survey, which is one of the most respected supply chain surveys, they're a top 25. They're the 14th ranked supply chain in all industries in the world. There was no other automaker even in that top 25 ranking, not Toyota, not GM, not Ford. Tesla's a 14th ranked supply chain. They've got massive advantages in terms of how they source, their long-term contracts, the platforming they do in their supply chain, their ability to have fewer SKUs and manage excess and obsolescence, their network design, being co-located and locally sourced around their factories. It means they've got very low latency around their supply chain, which means they're pulling product material through the system quickly and they're moving it out. Their inventory turns are quick. Again, their network latency is very low. This supply chain gets a 0 from analysts, and it is the hidden gem in terms of the Tesla, the performance from an operational perspective, from a COGS perspective, and the ability to get those industry-leading gross margins, which I believe they will revert back to after this point of compression. And to me, it's one of the biggest things that's going on right now inside of Tesla is the factory, the factories themselves, and then the supply chain feeding those factories behind it, and the whole methodology of simplification and focus on cost. They give it a 0. It's a huge advantage for Tesla.
Thank you, Jeff. That was amazing. You basically hit every single point I'm about to share and more. And I mean, FSD and Robotaxi, I mean, it's not just software. This is not just another thing that others have done, and it'll be licensed. But I love your point about, market is forward looking, and Tesla's always hitting innovation. Toni continues to view Tesla the way he has been since 2016, and he's been wrong all the time. Let's just quickly go through some more of these things that he's sharing here. Jim Hall said this, fun fact, Toni has never had a buy rating on Tesla, even though he's been covering it since 2016 when the stock was $16. All he's ever had was hold and sell, missing and fighting against a 2,500% gain, and he's been dead wrong for nearly a decade. This is his history, and he basically held for this long and looked like those were right calls. He kept selling whenever the stock just skyrocketed up, but now it's back where it is, and his view for Tesla has always been pretty bad, just not looking at it. And then here's a great example of one time in 2019 where he was warning and saying top tech analysts, it says electric vehicles from Jaguar and Audi are going to steal market share from Tesla. This was his big deal that he was pointing out. And of course, this is the I-Pace. It's not doing very well at all. And so that was a poor analysis on his part. Now I'm just going to walk through what Gary Black has said. He's a Tesla bull. He really does believe that Toni is one of the more respected analysts out there. But this is the difference. He goes, here's the difference. So the most important driver of a company's stock price are future earnings. Tesla bears are quick to point out that the fundamentals and earnings revisions have been declining for a year now. 2024 earnings per share adjusted is declined to $3.93 from $6.92 a year ago. So those are facts. Normally, this would cause Tesla's stock price to fall accordingly, but Tesla's stock is 45% over the past year versus the NASDAQ. Bears forget that markets tend to look forward. You pointed that out. And we see the bulls see Cybertruck and the Model 3 Highland, the 7,500 EV credit going off invoice. You've been hammering that home for the last several months. And the $25,000 next-gen vehicle, we've now been hearing that this is further ahead than we realized, driving future volume growth and margins. Markets also assume that Tesla's auto gross margins are stabilizing, combined with falling interest rates. I mean, come on, how can he believe that Tesla stock will fall as interest rates recover? Has boosted Tesla PE to a current 62 times Wall Street estimates from below the 20 times PE back in January. So Tesla now sells at its median PE over the past 3 years. To move higher from here, Tesla earnings revisions have to turn positive, which are most sensitive to volumes first and auto gross margins second. And then this, he said, Tesla's bear, Toni Sacconaghi, who's highly respected among the institutions, is staking his short thesis on his view that Tesla's auto gross margins have to fall more for Tesla to grow volumes. I and other bulls are betting that auto gross margins can stabilize and deliveries can grow by 20-25% CAGR going forward. So that's the debate in a nutshell. Any thoughts on that?
Yeah, the other thing is his big idea for 2024 is not only that he's a sell, but his big idea is to actually short the stock. So this is more than just he doesn't believe the stock should be where it is, and he thinks it's going lower. He's actually saying you should bet against the stock. That's his advice. And like I said, they're missing a number of different things. So if I could leave you just with two things or three things. One is we've talked about the option value of FSD and so forth. Fine, put that to the side. One thing. The second thing is I told you they give Tesla's supply chain a 0 in terms of valuation. It's gold. It's better than any supply chain in the auto industry. And quite frankly, it's one of the top supply chains in any tech industry. That means great on inventory. That means low COGS. That means they have supply continuity, supply availability, and that's going to be key as the EV market ramps up. And the final thing, and I want to leave the viewers with, is who's doing the math? Let's just take North America, for example. And this year's SAR, this is the predicted retail sales of automobiles in North America, is I think around 16 million units right now. It's been somewhere between 15 and 16 million. And let's just say it's flat next year. We have rates declining. There's a number of reasons to believe why it could be flat. We can also go look up the data and see where people can be. EV adoption is predicted to be in the right around the 12% range. So you're going to go from 2 million cars, EVs that may be shipped to North America, to somewhere around 1.8, maybe 1.9 million EVs in North America. The only EV manufacturer in North America that's been meaningfully adding capacity has been Tesla. They publicly pulled back on their CapEx investments. They're only doing a couple thousand cars a month. So who's gonna take that jump from 1.2 to 1.9 million EVs if they're not adding the capacity? And of course, the foreign automakers that they build abroad, they're not going to get the EV tax credit that Tesla's going to join, and they would also get massive inbound duties. So if they haven't added the capacity, it's not online and it's not ramped up, Tesla's the only one that's added the capacity and has it ramped up and ready to go. So think about that move just in North America alone of going from 1.2 million EVs to about 1.8, 1.9, depending where you call it. It's fine. It's going to grow, and no one else has put the capacity in, and Tesla has. So I just leave people with those three takeaways on the options and on Tesla supply chain, and then who's going to handle this growth in EV adoption, especially in North America. I don't see the other solution that's out there. No one's actually, when I put that out there, no one's able to give me a really good answer besides Tesla.
Wonderful. Thank you so much, Jeff. We are Tesla bulls, and so it's fun to look at how other people look at the stock. I think what you said a little bit earlier is what I look at, which is, market looks forward and Tesla continues to innovate. So even though the stock has been flat for many years, at some point it catches up, and you can't just look at volumes and deliveries and gross margins for the cars only. Things are about to change big time, even in the cars, multiple segments. Thank you, Jeff. Love it. Appreciate you so much. Follow him on X at the Jeff Lutz. Thanks, everybody. Bye-bye.
Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.